What's up, traders? Todd here. Welcome to the free video update. It's Monday night, the 28th of August, last week in August. Here we go. September, it's been bumpy. It was down. Is this the start of something greater? And we're going to sell off at the end of the year? Or is it just a wee little pullback? Let's take a look here. Okay. First thing I want to share with you is this is kind of fun. If we saw the high, back here in January of 22, we declined over 280 days, right? Well, the market has recovered and we have not yet taken out the S&P high yet, right? So if this is the start of a new bear trend, obviously we don't want to make a correction that goes to new highs because that's not a correction, right? So we're still below the highs. But what's interesting is the amount of time, okay? We're not talking so much price, but we're talking time. The time elapsed in the decline here was 280 days. In the S&P, we've been rallying for 322 days. So it's kind of hard to say, we're in a correction if we've been rallying for more time than we were declining, okay? Over to the NASDAQ, it's actually very timely. The NASDAQ topped out here on November 25th of 22 and then sold off down into October 13th. That happened over 321 calendar days. Well, today was 322 days of rally. So today is like we just passed the same amount of time rallying that we sold off. So we have the NASDAQ and S&P confirming, it's more important that price takes out the highs, but time is a very good indicator. Okay. All right, so we did a report today. We do it every Monday. It's called Big Macro Monday or the Macro Mash for our members. And I want to share a couple excerpts I thought was really key. The big driver here, guys, is interest rates, right? It's not only where the long-term rates are going with 10 years, but also where the short-term rates are going with 2-year yields, right? It's the interaction between those two, the 10s and 2s, that creates the yield curve, right? And that's really what's driving this market. And the 2-year bumped up a little bit above 5% here, but the markets are pricing in potentially one more rate hike in November, but that's a long ways away. So we'll see if that holds, okay? So it's the interaction between the yield curve. The yield curve is still inverted, okay? So we're looking at the nominal yield curve down here. Sorry, it's hidden behind that. Oh, there we go. The nominal yield curve is still inverted, which means the 2-year rate is above the 10-year rate, okay? It's come off the worst levels, right? We have the inversion sort of easing here. But if you look at when you factor in inflation, okay, it's a big difference right now, and it's what's different than a lot of the other prior times when we have yield curve inversion. You got to look at the real rates, and the real rates is what is the inflation expectation compared to your nominal rate. If you're borrowing at 5%, but your money is being inflated away at 5%, like it effectively is, it's a zero real cost to borrow. Right. And that's why like interest rates on mortgages and credit cards and even corporate borrowing, with the core CPI still, and we'll talk about that in a little bit, still at elevated rates. You take your nominal cost to borrow and you factor in how much, when you're borrowing money, when you're a debtor and there's inflation, that's good, right? Because you're inflating your debt away. So when you look at the real yield curve here, I captured this morning, 49 basis points of inversion, where the nominal yield curve is still at 76, right? So you could see that the real yield curve, when you factor in expected 10-year inflation and 2-year inflation into those nominal rates, yeah, we have the yield curve normalizing or getting more steep. Right. So when somebody says, oh, yield curve inversion, recession comes, sell stocks, and we've talked about this a lot in other videos and with our members, it doesn't necessarily mean that. So be careful reading too many headlines. This is a fun chart I want to share with you quickly. This is a new one. This is called the real cost of money. So it's the Fed funds rate subtracting core CPI year over year. And without getting into too many details here, the thing you want to keep in mind is back here in the 70s, I know it's really small, 70s and 80s, we did have a lot of stagflation and economic stagnation. Because why? Well, the real cost of money was very high, which means the Fed funds rate, the borrowing rate, is higher than the actual core CPI. Right. Well, that's been declining. And yeah, we've come up off the lows, but we had negative real cost of money. So -5, -6%. Now we're at 1%. So the real cost of money is 1%, where we've had significantly higher 3, 4, 5, 6, 7, 8, 9 up here. Right. So it's the real cost of money on an elevated level that causes stagnation, number one. And number two, look what happens when the black line bottoms. Black line bottoms, stocks rally. Black line bottoms, stocks rally. Black line bottoms, stocks rally. Bottoms, rally, bottoms. Rallies into the GFC, bummer. We sell off here. Black line, real cost of money goes up, rallies, and look what just happened. We've had a significant cost of money go up without the stock market rallying, breaking to new highs. And what's happening here? How can real cost of money go up? Well, either the Fed is going to raise rates, keep raising rates, which I don't think that's going to be the case, or core CPI is coming down. That's disinflation. Disinflation, which is inflation, but at a slower rate of change, is good for equity. So if the real cost of money is going to go up, it's probably because your core CPI is coming down, and that historically would show that that is a good time for stocks. Okay. All right. So let's get off of that. Let's go have some fun over here. We're going to shift gears and show you where the Elliott Wave count is here on the market, and I'll show you the rotation that's happening and how we plan to take advantage of this. Okay. Now, this is the S&P. Okay, I'm hitting you with the heavy stuff, but that's just the kind of market we're in. This isn't your your simple red light, green light, buy sell market, man. This is for big boys. All right, so here's the S&P, and here is the best wave count that you'll find. So I'm seeing this as the end of corrective 2. We have 1, ABC flat 2, and now we're seeming to be rallying in 3, 4, and 5. Okay, pretty good fib support zone here in wave 4. As I've labeled here, 43 down to 42.53. We've held that zone. We could push down a little bit lower. That's fine. I'm going to show you the NASDAQ as well. But what I want to do is, as we go to the final screen here, is I want to show you basically the sector rotation that's occurred here from the March 13th low. All right. So in the S&P, I have us rallying in the minute degree, minute 3, pulling back in minute 4, and going to go up in minute 5 to complete high degree 3, which should bring you to new all-time highs. Here's the NASDAQ, slightly different wave count, and you're going to see there's a little bit of truncation, a little different than the S&P. But I have us in the NASDAQ rallying in minor 1, minor 2, minor 3, and then we have a nice big old deep FSZ, fib support zone, in the NASDAQ from 15,009 to 14,157. So what I want to do is show you the sector rotation that occurred in this wave 3. Wave 3 began on March 10th and completed on July 18th. In the NASDAQ, we have pulled back. And are we set to go attack the highs in minor 5 of intermediate 1? Okay. And that's going to be the S&P as well. What happened from March 13th up to the high, pulling back in 4, and there we go. Okay. So here's rotation. Okay, this is the only way to really look at sector rotation. Okay, you're kind of lost if you're not looking at it on RRGs. So what I've done is I've taken the 3 groups of sectors: cyclical, economic sensitive or growth, and defensive. And what I've done is percent change them from that wave 3, which is March 13th. So each of these percent change starting points are from March 13th of this year to today. Okay, so first thing I want to do is let's go all the way to the bottom and look at the defensive sectors in wave 3. And again, I just want to sort of just remind you, we're looking at a wave 3 breakout here from March 13th up to the top, pulling back, and will we see continuation with, keeping in mind everything we just said about interest rates and yield curves and real yield curves, man. I'm telling you, you got to put a lot into this market, but it's fun. Okay, So here's the rotation since we went into wave 3 in the S&P. Okay, we had a little bit of a move up here in defensive, which is healthcare, staples, and utilities. All right, so we had a little bit of a move up here, and I'm going to make them rotate. Okay, but look what's going on over here on the monthly. If you're heading down into the left, moving out of leading, heading into weakening, pointed towards lagging, okay, that is underperformance. Okay, and look, we're going to get here, but I just fast forwarded. Healthcare, utilities, and staples are pretty much, they're all now in monthly lagging. They have rotated out, all right? So let me go back to March 13th, and let me just show you how the rotation occurred here, okay? So here's March 13th, 2023, and we started to get a little bit of a rotation up here on the weekly, utility, staples, healthcare, but that quickly failed here in May, and they see, oh, they both hooked back down on weekly, but the monthly is still heading in sort of towards the basement, towards the toilet. They're just going sideways. Look, to continue to rotate out on the monthly, try to make a little go in healthcare, sort of flattening out. Healthcare is trying to rotate back in here on the weekly, but keep in mind, monthlies are on a bad track. Value is rotating out, period. Okay? So again, we're trying on the weekly. Okay, the healthcare's got a lot of lifting to do, and staples and utilities are still down here in weekly lagging, where the monthly, as I said, is on a clear path. Okay, let's go into cyclical, which is consumer discretionary, and I have them labeled over here if you don't know. Consumer discretionary, XLY, XLB's materials, and financials is in red, XLF, and XLRE is real estate. Okay, and they're all color coded too, so you can figure it out. All right, so what happened in the wave 3 here? Okay, well, it's a little bit different. First thing I notice is early goings. Look at the weekly. You have discretionary, real estate, materials, and financials rotating out. Okay, rotating out from March up into May. So, you know, it looked like March and May right here. Remember when defensive rotated in? Guys, what was happening there from here was the markets, everyone was expecting new lows, right? So on this rally in the S&P, people are like, oh, let's buy defense because the market is going to roll over, and everyone was bearish, and a lot of people were very wrong. Not everyone. A lot of people were bearish, and investors, rushed into the value stocks. Well, okay, what happened? Well, they got stuffed, right? They tried here into March and April, and then May, boom. Okay, well, didn't quite rotate into cyclical. Okay, we kind of got a rotation out, materials, financials, real estate, and consumer discretionary, XLY. But look what happened here in about May. Okay, look at XLY. Look at that hook right there. Nice hook up into the right. Materials, real estate, even with everything going on in the real estate market, and financials hooking up. Now, the other thing I'll draw your attention to is XLY here on the monthly. Look at this guy. It's kind of like sort of like a cobra that's like, I don't know, got his hood up, back arched and ready to strike, right? That's a really nice hook back into improving, which is the position that you want to see. That's the setup that alpha is made of right there, okay, from that position. And XLY, look what it did. Ripped to the top side. Okay, so XLY, the monthly, in this wave 3, made a really, really good move from monthly lagging into improving. It's over here on the right side on the weekly, so it's losing some relative strength, a relative momentum, I should say, but it very may well rotate back up, and that would allow XLY monthly to continue to move into leading. The other guys on the cyclicals, financials, materials, and real estate are trying, they're doing their best, but they're a little messy over here on the monthly. All of these guys, if they want to participate in this rally, could really stand to rotate up, and then that would allow these guys to continue to go from weekly improving to weekly leading, okay? So it's possible, but XLY, I tend to group more with growth stocks because of obviously some of the large cap stocks that move XLY are more growth, right? Like Tesla, right? And Amazon, I would say. So that's fine. Okay, so let's get into the one you probably care about most, which is economically sensitive / growth sectors. Now, S&P puts industrials and energy in with tech and comms. I don't know if I fully agree with that, but that's the convention, so I'll just group them like that. So what happened, again, at that wave 3 low? So here's March. What happened? Got a little bit of a rotation into tech and comms. There's XLK, XLC. Okay, and what's going on here on the monthly? Tech is in gray, comms is in red. Beautiful hook out of the basement, heading up into improving. Okay, there we go. What's happening? Okay, good move on the weekly. Starting to lose these guys just a little bit. Okay, let's keep going. Okay, now what's going on? Monthly, they're still moving in a great direction. Industrials are kind of rotating out. Industrials have already had their move. They had their move back here at the end of 22 and in the first quarter of 23 and half of 23. But now what's happening is comms and tech are in a beautiful monthly position on a beautiful northeast heading to get right well into leading, which means growth is leading this market again. Okay. Now what's really interesting is look at the little hook that just happened in XLC. Okay, you can see the percent change difference in XLC, XLK. In that wave 3 that I showed you, XLC is up 26%, comms up, tech up 24, XLY up 19, financials up 8, materials up 5, real estate's flat, healthcare up 6.7, staples flat, utilities down. Okay, but what I find really interesting is look at the hook here in XLC. We don't yet have it in K, but XLC via your Meta, your Netflix, other big guys, Google you're starting to see a little bit of a hook here in comms. Now, if that happens, if we continue to hook and you do a hook from weekly weakening and you head back into leading, that all but guarantees communications is going to move into monthly leading. Technology is slowing and it needs to do the same hook the way semis have been acting. I think it's going to happen, and that is going to further allow technology to go into monthly leading. So when you put it all together with where real interest rates are, where the real yield curve is, where sentiment, where positioning, how Q2 earnings were, how Q3 guidance was, how people are still bearish, and you have tech growth, comms, and consumer discretionary rotating in, I'm not bearish. So we're going to go to work tomorrow in, we call it Taco Tuesday Sector Industry Stock Report. We go through all these sectors and we break it down, all of the industries that are performing the best within these sectors. Then we go through and find the best stocks to trade and consider them to put in as a stock trade alert or in our ongoing portfolio. So big day tomorrow. You should join us if you want to see it, tradeanalysis.com. If not, see you on the next video update. See you guys. Hi, it's Todd from tradinganalysis.com. Thanks so much for watching. Listen, my team and I have so much to share with you in terms of our technical analysis, our fundamental analysis, portfolio management tactics, trading in and out, maybe options, sector rotation. Let us know what's most interesting to you. Maybe drop that in the comments section and we'll do our best to work it in. Also, consider clicking the subscribe button and the bell icon to be notified when we put out new videos. And finally, you can check us out at tradinganalysis.com if you'd like to see us manage our real portfolios in real time. Thanks again for watching.